You've seen the absolutely wild price swings of Bitcoin, right? Well, if you've ever wished for a calmer alternative in the crypto world, that's exactly where stablecoins are supposed to come in. They're designed to be a safe port in crypto's stormy sea. But there's a really fascinating puzzle right at their core. And that is the huge mystery we are unpacking today. It sounds like a total contradiction, doesn't it? If a coin is supposed to be pegged one-to-one with the US dollar, how can it ever break that peg? And believe me, this isn't just a what-if question. It happens all the time. And we're not talking about some rare glitch here. Just look at Tether, the biggest stablecoin on the planet. Its price is constantly wobbling around that $1 mark, sometimes trading for a little more, sometimes a little less. This constant wiggle really makes you ask, what is going on here? What's causing this instability in something that's literally named for being stable? To solve that mystery, we first have to understand why people even use these things in the first place. I mean, if you've got real US dollars, why would you want a digital dollar that isn't always worth exactly a dollar? Well, the answer is that stablecoins are the secret, high-speed engine that makes the whole crypto economy run. It really boils down to this. Trying to use real dollars to trade crypto can be super slow. You're dealing with bank processing times, higher fees, and here's the kicker. A lot of the world's biggest crypto exchanges don't even take real dollars. They only accept stablecoins. Stablecoins, on the other hand, move at the speed of the blockchain. We're talking near-instant transactions and lower fees, which makes them the absolute perfect vehicle for traders. And the scale of this is it's mind-boggling. On an average day, the total amount of Tether being traded is often bigger than its entire supply. Think about that. It means the average Tether coin is changing hands more than once every single day. To put that in perspective, the good old US dollar moves at about 1/10 of that speed. This is not some niche product. It is the lifeblood of crypto trading. Okay, so we know stablecoins are absolutely critical. Now let's get back to our mystery. These price swings away from $1, they aren't random. They're caused by two very distinct forces. You've got forces that push the price above a dollar, that's called a premium. And then you've got forces that drag it below a dollar, creating a discount. So why in the world would a stablecoin ever be worth more than a dollar? Well, it happens in moments of pure panic. Picture this, the entire crypto market is crashing, kind of like it did when the COVID-19 crisis first hit. Traders are scrambling to sell their Bitcoin and get into something safe right now. Moving to real dollars takes time they just don't have. So what do? They all pile into stablecoins at the exact same time. This massive sudden rush for a safe haven jacks up the demand. And all of a sudden, a $1 coin is trading for $1, maybe even more. Now for the other side of the coin, the discount. This happens when the fear isn't about the market, it's about the stablecoin itself. So back in October 2018, the crypto exchange Bitfinex, which has really close ties to Tether, dropped this bombshell announcement. They were pausing US dollar withdrawals. This sent a shockwave through the market, sparking this huge fear that maybe, just maybe, Tether wasn't actually backed one-for-one by real dollars like they claimed. And the market's reaction was immediate and brutal. Right after that announcement, you see Tether's price just fall off a cliff, down to 95 cents. At the same time, the bid-ask spread, that's the gap between what people are willing to pay and what people are willing to sell for, it just exploded. That's a massive sign of panic and uncertainty. It was all driven by one single fear, that the dollars backing Tether just weren't there. Okay, so we've got these two really powerful forces, this rush for a safe haven and this fear about the collateral, knocking the price all over the place. So what pulls it back? It's not a central bank, it's not a government. The hero of our story is actually this invisible profit-seeking force called arbitrage. Put simply, arbitrage is basically just finding a loophole where something is being sold for two different prices at the same time, and then you exploit that difference for a risk-free profit. It's the engine that keeps stablecoins, well, stable. Okay, here's exactly how it works. When Tether is trading at a premium, let's say for $1.01 on an exchange, smart traders can go straight to the source, the Tether treasury, and create brand new Tether for exactly $1. Then, they immediately turn around and sell that Tether on the open market for $1.01, instantly pocketing a penny of pure profit. Now, when thousands of traders all do this at once, their collective wave of selling naturally pushes the price right back down toward $1. And what's so elegant about this is that the exact same logic works in reverse. If Tether is trading at a discount, say for 99 cents, arbitrageurs will swoop in,
buy up all those cheap coins on the market and take them straight to the Tether treasury, where they can redeem them for exactly $1. This creates a huge wave of buying pressure, pushing the market price back up towards the peg. It's just a beautifully simple and powerful balancing act. Now check this out. If this whole arbitrage theory is correct, you'd expect that when arbitrage gets easier, the stablecoins should get, well, more stable, right? And that is exactly what happened. Before April 2019, doing this was actually kind of hard and expensive. But then Tether moved over to the Ethereum blockchain, which is a much faster and cheaper network. This suddenly threw the doors wide open for way more investors to get in on these arbitrage trades. And the result was dramatic. After Tether made that move to Ethereum and all these new arbitrage players jumped in, the average price wobble shrank by over 57%. This right here is the smoking gun. It's crystal clear proof that the more people who can make these simple, profit-seeking trades, the more stable the coin becomes. So we've pretty much solved our mystery. The price of a stablecoin isn't guaranteed by some promise on a piece of paper. It's actively and constantly maintained by a decentralized army of traders. And that has some really profound implications for how we think about the future of money itself. So let's just recap the key takeaways here. First, stablecoins are the essential high-speed plumbing that makes the entire crypto world go round. Second, those price wobbles are driven by pure human emotion, fear of a collapse, and a desperate flight to safety. And finally, and this is the big one, stability isn't dictated from the top down by a central bank. It's something that emerges from the bottom up, enforced by the collective self-interest of thousands of individual arbitrageurs. Which really leaves us with a final provocative thought. For centuries, we've relied on big, central institutions to keep our money stable. Stablecoins offer a totally different model, one where stability is maintained by an open, transparent, and decentralized system of incentives. It really makes you wonder, as we continue to build the future of money, could this kind of decentralized trust actually prove to be more resilient than central control?